The price of crude oil is back up over $100. That is following a dip earlier this week. On Wednesday, we saw the price of oil go down as low as 96 bucks. That was on recession fears. And there has been quite a bit of speculation as to where the price of oil will be heading in the future. We have analysts at Citi speculating that the price of oil could drop down to the $60 level in the midst of a recession. We also recently had JP Morgan analysts send a letter to investors predicting that the price could go as high as $380 in the event of Russia cutting their production drastically. So, where is the price of oil going to go? What's going on with the oil market? One of the stories that's been making headlines regarding oil recently has been the sale of oil from the Strategic Petroleum Reserves to China. And I think this is a bit of a red herring, a bit of a nothing burger. The story is that more than 5 million barrels of oil that were part of the sale of oil from the Strategic Petroleum Reserve wound up being sold to Europe and Asia last month. And we've got this headline from Fox Business. GOP hammers Biden for allowing emergency oil reserves to go to China, compromising our energy security. And listen, I like to pile onto the current administration as much as the next guy. A lot of the stuff they're doing is not good. I mean, selling from the Strategic Petroleum Reserves at all is not a particularly wise plan. But this idea that selling to China or to other countries compromises our energy security is a little ridiculous, I think. I mean, it's an open market. They're just trying to get the price of oil down. So they're going to sell to whoever the highest bidder is. And if that's China, so be it. I mean, some of that oil will probably even end up coming back to us in the form of refined products. So I really don't think that this story is anything but a distraction. But there is a story out there that is not being told, which is incredibly important. And I'm going to get into that here in just a minute. But first, I do want to talk just a little bit more about the Strategic Petroleum Reserve. So this is the latest data from the Department of Energy. It tells us up here that there's 492 million barrels remaining in the Strategic Petroleum Reserve. And then here's a chart. This is from the Energy Information Administration of the levels of the SPR. Now, this only goes to April of 2022 for whatever reason. The reason I want to pull this chart up is to show you that to get to a time when the Strategic Petroleum Reserve was below 500 million barrels, you've got to go all the way back to 1986. This really is unfortunate. This is newsworthy that the Strategic Petroleum Reserve is being used in this way, and it continues. They're going to be selling about 1 million barrels per day out of the SPR until October. So, we're going to see this level go even lower. The purpose of the SPR is in the event of a conflict, or some kind of a massive energy crisis, that you have the oil you need for the essential functions of society and for government. And the way we're seeing it used is it's just being used to bring down gas prices before an election, essentially. I mean, that's what's going on here. And just remember that in the future, if they want to build the Strategic Petroleum Reserve back up, they're going to actually have to go into the market and purchase oil. And so the downward effect that we're getting now, to the extent that the SPR gets refilled, is just going to be an upward effect on the price of oil at some point in the future. So it's a net nothing. It shouldn't be used this way, but the whole idea of them selling it to China or other countries, really just a bit of a distraction. But the real story here, which is not getting nearly enough attention in the mainstream media, is this story about the G7 placing a cap on Russian oil. And there's a lot more to this story than meets the eye. I reported on this about a week ago when they first made this announcement, and at the time it was kind of unclear how they were going to implement this, what the mechanism was going to be. I knew it would be something kind of convoluted because the G7, they're not even really buying much Russian oil. The EU already has an embargo against them, and that is very relevant to this story, and I'm going to tell you why in just a moment. But it wasn't clear how they were going to do this, and their motivation for it was somewhat unclear, except for the fact that they were just targeting Russian oil revenues. But this is an article from David Wessel that was published earlier this week from the Brookings Institution. He's a director of the Hutchins Center on Fiscal and Monetary Policy, as a senior fellow at the Brookings Institution. And if you haven't heard of him, because he wasn't on my radar until I found this article, David M. Wessel at Twitter, you should definitely go give him a follow. And this article is titled "The Story Behind the Proposed Price Cap on Russian Oil." And it brings a lot of things to light which have not been covered in the mainstream media, but which are extremely important related to this move. And so the whole idea is, the G7 wants to cap the price of Russian oil. They want to put an upward level on the price that Russia can sell oil to other countries, not G7 nations. So they want to limit the price that, say, China and India and other BRICS nations can pay for Russian oil. And I'm going to read a bit of this article to you because it's very interesting, his take on this. There's more to the story than oil buyers talk of a ceiling on the price they're willing to pay for Russian oil. At the beginning of June, the European Union agreed to bar its companies from insuring and financing the transport, in particular through maritime routes, of Russian oil to third parties after the end of 2022 to make it difficult for Russia to continue exporting its crude oil and petroleum products to the rest of the world. And you don't have to take his word for it. This is a Q&A from the European Commission from June 3rd of 2022. And there's one paragraph I want to bring to your attention here. It says, after a wind down period of 6 months, EU operators will be prohibited from insuring and financing the transport, in particular through maritime routes, of Russian oil to third-party countries. This will make it particularly difficult for Russia to continue exporting its crude and oil products to the rest of the world. Okay, so why does that matter? Well, David explains it to us here in this article. This is a big deal because European and British companies account for about 85 to 90% of the business of insuring, reinsuring, and financing seaborne Russian oil. Owners of oil tankers of any nationality will refuse to carry Russian oil if they can't get high-grade insurance. The operators of the Suez Canal, for instance, don't permit uninsured ships to sail through the vital channel. Russia, in response, says that its state-owned insurance company will provide the reinsurance that British and European firms won't. So, yeah, Russian and Indian and Chinese insurance companies may step up to fill this void, but, think about the liability involved with an oil tanker. I mean, if something goes wrong, it could be an absolute disaster. So you really want a insurance company with a long history to be the one insuring your ship. So, I mean, eventually, I think the long-term repercussion of this is that it's going to be bad news for these insurance companies in Europe and Britain because they're going to lose a lot of market share. But in the short term, Russia is going to struggle to find a replacement for that insurance. So this insurance ban would hurt Russia by reducing its oil exports, but the resulting restrictions on the supply of oil flowing to world markets would drive the price even higher than it is already. The Brent benchmark price was above $100 a barrel at the beginning of July 2022, and as we know, it's still there. Analysts at Barclays say that disrupting Russia's seaborne crude exports could push oil prices above $200 a barrel. The insurance ban would have further-reaching consequences for the oil market than the EU oil embargo. That is Commerzbank analyst Karsten Fritsch telling the AFP wire service that. So, this could be a real problem if this aspect of the European embargo kicks in at the end of 2022. So back to the article. American officials are understandably reluctant to criticize their European and British allies for the well-intentioned, if poorly conceived, decision to ban their firms from insuring and financing seaborne shipments of Russian oil. And that's how we get to this whole scheme to cap the price of Russian oil. Basically, the U.S. Treasury officials devised a way to prevent this sanction from tanking the world economy, exempt from the finance and insurance ban any shipments of Russian oil that are sold for less than some publicly set price. This would allow the ban to remain in place. Undoing it is seen as politically impossible, while preventing it from taking full effect and triggering a devastating spike in oil prices. The only reason this has a chance of working is that the British and European companies largely control the insurance and financing market for oil tankers, and particularly ships that carry refined petroleum products. It's not a scheme that could work for other commodities in other markets. Okay, so, this plan is basically the G7 leadership trying to have their cake and eat it too. They want to impede Russia's ability to reap these record revenues from their oil exports, but they also want to be able to buy that Russian oil cheaply. So I'm very skeptical of this scheme's ability to succeed. It would require Russia to play along, of course. It would also require China and India and all those countries that are buying Russian oil to play along. Now, there is some incentive for countries like India and China to take part in this because they're going to be able to buy Russian oil much cheaper. And Russia itself, he points out in this article here that Russia may have a hard time shutting down their oil production because oil wells are hard to start back up once they are shut down. And if Russia decides to halt production, it may have a very hard time restarting that production in the future. And so this could have a severe and lasting damage to its production capacity if they don't play along and sell their oil for cheap. But I don't know. I mean, I have a really hard time seeing Russia agreeing to any kind of scheme like this. This is the same country that's threatening to drop nuclear weapons on London. So to see them kind of kowtow to this sort of economic warfare, so far, I mean, they've been highly resistant to any of these restrictions and any of these embargoes and sanctions on them. They've managed to weather the storm pretty successfully. So, I don't know what kind of a chance this cap program has of going into effect, but I'll just read the final paragraph here of this article from the Brookings Institution. But the unpleasant alternative to the U.S. devised plan is to allow the European and British ban on financing and insuring tankers carrying Russian oil to take effect at the year end, which would curtail Russia's exports but would also push world oil prices so high that a painful global recession would likely ensue. So I guess those of us in the West, we better hope that this cap program goes into effect, because if it doesn't, we're going to see these other aspects of the European sanctions kick in less than 6 months. It's already July, so the end of 2022 is not that far away. And if that happens, we're in for some pretty big problems, because we're already heading into a significant recession. And should the price of oil double from its current levels, that's going to become an economic pullback, an economic depression or recession, likes of which none of us have seen in our lifetime. So, get prepared. $100 oil may seem cheap 6 months from now. And that's going to mean, much higher commodity prices across the board. I would expect that the precious metals would be moving much higher should oil head towards $200. The price of gas, of course, will be dramatically higher. So, do what you can to get prepared at this point. Maybe get used to riding a bike. I don't know, but it's not looking good, folks. And there's a reason I think that this story is not getting a lot of coverage in the mainstream media. Let me know what you think in the comments below. Are we going to see barrels of oil selling for $200? Is the cap going to work, or is it going to fail? I mean, it seems like kind of a convoluted scheme to me with a low probability of success, but who knows? Maybe they'll pull it off. And if they don't, what do you think will happen with the shipping of Russian oil? What do you think will happen with the insurance? Will some new insurance company step in and fix the problem, or is this going to be as disastrous as those analysts at Barclays say? Let me know what you think in the comments below. Thank you all very much for watching. Don't forget to like, comment, and subscribe, and I'll catch you next time. Smart Silver Stacker, out.